What if I told you that your safe index fund could be making a much bigger bet on artificial intelligence than you ever intended? You didn't choose it, but your fund may have chosen it for you. For years, investors have been told to buy index funds, invest consistently, and ignore the daily market noise. That's still excellent advice. But even great strategies deserve an occasional checkup. Today's stock market has been powered by a handful of giant technology companies. As they've grown larger, they've quietly become a larger percentage of many ETFs and index funds. That's where today's story begins. Welcome to the Simply Speaking About Money video channel. It is here where we talk about budgeting, saving, and investing in the real world of probabilities, and not the crazy hype, noise, and lottery-like promises of possibilities. Many people hear the word diversified and assume every company inside an index fund gets an equal slice of the pie. That's a bit like assuming every player on a football team gets the same amount of playing time. They all wear the uniform, but some spend a lot more time on the field. That's exactly how many index funds work. The biggest companies receive the biggest weighting. As those companies grow larger, they naturally become a larger part of your investment. It's automatic. If one company doubles in value while hundreds of smaller companies barely move, that one company begins carrying much more weight inside the fund. Success creates even more influence. In fact, it's one reason index funds have produced outstanding long-term returns. They naturally let successful businesses become a larger part of the portfolio. But every strength can have a trade-off. Artificial intelligence is driving enormous excitement across the market. Companies building AI chips, cloud computing, software, data centers. Almost anything connected to AI seems to attract investor attention. Sometimes it feels like companies could sell AI-powered toothbrushes and investors would line up anyway. To be fair, artificial intelligence is a remarkable technology. It has the potential to improve productivity, medicine, manufacturing, transportation, and countless other industries. This isn't about questioning AI. It's about questioning investor expectations. Markets have always loved exciting stories. Railroads, electricity, automobiles, the internet, smartphones. Each one transformed the world. But investors sometimes became so excited that stock prices raced far ahead of reality. That is an important distinction. A revolutionary technology can absolutely change the world. That does not automatically mean every stock connected to it is worth any price investors are willing to pay. Great businesses and great investments are not always the same thing. Here is where many beginners become confused. They think owning an S&P 500 index fund means every company contributes equally to their returns. In reality, a relatively small group of very large companies often drives a significant portion of the market's performance. That is concentration, even inside diversification. Imagine you're baking a fruit pie. The recipe calls for 10 different fruits, but someone quietly adds 3 extra cups of blueberries. Technically, it's still a mixed fruit pie, but it's going to taste an awful lot like blueberries. Your ETF can work the same way. So the real question isn't whether artificial intelligence is good or bad. The real question is this: have today's biggest AI-related companies become such a large part of your portfolio that they deserve a closer look? In the next section, we'll explore exactly how concentration risk develops inside index funds, why it happens naturally, and, most importantly, what long-term investors should actually do about it without abandoning the investing strategy that's helped millions build wealth over time. Let's answer the big question. What exactly is concentration risk? It's simply having too much of your investment performance depend on too few companies. That's all it means. Think of your portfolio like a four-legged table. If all four legs are strong, the table is stable. But if one leg suddenly supports half the weight, every little wobble becomes much more noticeable. That's concentration risk in action. Many investors look at an ETF and see hundreds of company names. That certainly sounds diversified. But what's really important isn't just how many companies you own. It's how much of your money is invested in each one. Imagine owning 100 rental properties. 90 of them earn a few $100s a month. The other 10 generate almost all of your rental income. Wouldn't you pay close attention to those 10? The same idea applies to your investments. Most popular index funds are market cap weighted. That simply means larger companies receive larger allocations. As those companies grow, they naturally occupy more space inside the fund. No committee is making daily decisions. The math does the work automatically. That's one reason index investing has been so successful. The market rewards companies that continue growing. Winning businesses become larger positions. Weaker businesses gradually become smaller. It's an elegant system. But markets don't always move in straight lines. Sometimes enthusiasm becomes excitement. Excitement becomes optimism. And optimism quietly becomes overconfidence. That's usually when investors stop asking reasonable questions. History gives us plenty of examples. The railroad boom, the radio boom, the dot-com boom, even the housing boom. Each one was built around something real. But excitement eventually outran expectations. Artificial intelligence may become one of the greatest technological advances of our lifetime. Very few people doubt its long-term importance. The real uncertainty isn't whether AI matters. It's whether today's stock prices already assume years of perfect success. Successful investing isn't about asking, will AI change the world? It probably will. The better question is, how much of that future success is already reflected in today's prices? That's a much harder question. Here's another way to think about it. Imagine paying $20 for a hamburger. It might be the greatest hamburger you've ever tasted. But if the restaurant next door sells an equally good one for $8, price suddenly matters. Great products can still become expensive purchases. That's why disciplined investors pay attention to valuation. Not because they can predict tomorrow's market, but because paying any price for a great company has rarely been a winning strategy over long periods. Patience still matters. Now, before anyone misunderstands, this is not a prediction that AI stocks are about to collapse. Nobody knows what the market will do next month or next year. If someone says they do, they're probably also confident they can predict next week's weather 3 months in advance. Good luck with that. Instead of trying to forecast markets, focus on what you actually control, how much you save, how often you invest, your asset allocation, your diversification, your emotions. Those decisions have a much bigger impact than tomorrow's headlines. This is where long-term investing separates itself from speculation. Speculators ask, what stock will make me rich? Long-term investors ask, how do I build wealth, regardless of which company becomes tomorrow's winner? That's a completely different mindset. In our final section, we'll look at practical ways to manage concentration risk, avoid emotional investing, and continue building wealth with confidence, even if today's hottest AI stocks eventually cool off. So, what should you actually do? The first answer is surprisingly simple. Don't panic. One of the biggest mistakes investors make is confusing market excitement with investment strategy. Those are two very different things. Instead, take a closer look at your portfolio. Spend a few minutes reviewing the top 10 holdings in your index funds or ETFs. You don't need to memorize every company. You simply need to understand where most of your money is actually invested. Knowledge reduces surprises. Next, ask yourself one simple question. If my largest holdings dropped 20 or 30%, would I still feel comfortable owning this investment? If the answer is yes, you're probably investing with a plan. If the answer is no, it's better to make adjustments during calm markets, not during the next market panic. Remember, owning successful companies isn't the problem. In fact, many of today's largest AI-related businesses are exceptional companies. They have strong balance sheets, enormous cash flow, global customers, and talented management teams. The concern isn't quality. The concern is becoming overly dependent on just a few companies. Think about flying on an airplane. Modern aircraft are incredibly reliable, but they're also filled with backup systems, not because engineers expect failure, but because smart planning assumes unexpected things can happen. Diversification is your financial backup system. That's why many investors spread their money across different sectors: technology, healthcare, financial companies, industrial businesses, consumer products, utilities, energy. Each sector has its own season to shine. No one stays on top forever. Some investors also diversify across company sizes: large companies, medium-sized companies, and smaller businesses. Tomorrow's market leaders often begin as yesterday's overlooked companies. Owning a broad slice of the market increases your chances of participating in that future growth. Others add international investments. The United States has produced outstanding companies. But innovation isn't limited by national borders. Different countries experience different economic cycles. Global diversification can reduce dependence on a single market. And don't forget bonds. They're rarely exciting. Nobody brags at a dinner party about their bond allocation. But when stock markets become turbulent, high-quality bonds can help smooth the ride. Sometimes boring is exactly what your portfolio needs. Here's the funny thing about investing. People often spend hours searching for the perfect stock, yet spend only a few minutes reviewing their overall portfolio. That's a bit like buying expensive tires while never checking the brakes. The whole system matters. Markets move in cycles. Technology leads, then another sector takes over. Sometimes healthcare, sometimes energy, sometimes industries. Nobody was talking about just a few years earlier. Leadership changes. Discipline doesn't. That's why successful investors focus on what they can control: saving consistently, investing regularly, keeping costs low, staying diversified, and ignoring the daily parade of financial drama. Those habits have built far more wealth than chasing the latest headline. Remember, artificial intelligence may absolutely transform the global economy. Many of today's leading companies could continue growing for years, but nobody knows exactly which businesses will dominate 10 or 20 years from now. That's why diversification remains one of the smartest investing tools ever created. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money, so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further.